Welcome everyone. So how many of you have life insurance policy right now? Great, many of them. That's good to know. And out of that, how many would be having term life insurance, that is not having an endowment or a ULIP? That's also good. I mean, maybe 50% term life and 50% traditional, which is not bad, considering that term life is not yet popular as much as endowment. How about life insurance, health insurance, say Mediclaim policy? Great. A lot of them do need Mediclaim. I mean, all of them actually need, even students and especially elderly. Personal accident insurance. Few, that's expected. Actually, it's not as popular, but actually the one which is the most cheapest and everyone should have. Again, car insurance only if you have a car. Of course, people have car and they do have car insurance. Travel insurance only if you're traveling and not required if you're not. Home insurance, probably very few. I'm assuming people may be having home but may not be really having insurance, but we'll talk about it. Now, you may see this picture with a person having a sack full of money to give to the insurance company for a premium. In reality, I wouldn't say it's expensive, especially the personal accident, which is quite inexpensive, and online term plans, which are also very inexpensive. So those two actually are very much affordable for anyone. Health insurance, yes, it's a little expensive for the elderly, and there are few reasons for that. One is that there is no regulator for the hospital charges, so those are escalating quite rapidly. I mean, if you go to a good hospital, you can end up with a good amount of bill, like a kidney stone surgery can cost 50,000, which is quite expensive. Other reason is that people who have insurance, they tend to go to a good hospital. So you have insurance, you want to make use of it, so you have to do a kidney stone surgery. A smaller hospital might cost 25,000, good hospital 50,000. Since you have cover for 1 lakh or 2 lakh, you are saying, yeah, I'll go to the bigger hospital. It does increase the cost for the insurance company, which actually comes down to the premium which will get charged to everyone. And the third reason is that there is low penetration for health insurance today. So because of that, the insurance companies don't have that good numbers to show by which they can reduce the premium. So if a lot of young people start insuring themselves for health insurance, you would actually see a drop in the premium. Now, health insurance, those I'm sure some of you are from the corporate sector and you have the policy which is offered by the company, and that's great because you don't have to pay the premium from your pocket and you would enjoy the benefits of insurance without really having to buy a retail policy. But those who don't can think about a retail policy because that's something everybody needs at every age. So let's start. If you have any questions, we'll take it during the question answer series, but if you have something which is not clear, then you can definitely bring it up and I'll clear it up as we go along. So why do we need personal accident insurance? That's the first one on my slide because that's actually the cheapest and really something which people don't know of. This is a tragedy of life where this is a photo of movie Ravan lead animator who, after celebrating success of getting an award, national award, she met with a accident and actually paralyzed neck down. Where just last week, Times of India reported that after 2 months of the accident, she's having no sensation in hands or feet, so the whole spinal cord is actually permanently damaged. Of course, there's expenses which would have been covered by health insurance if she had one, but I don't think she had health insurance, so the family may have paid maybe 10 lakhs or more till now, and which can go up as she progresses through the recovery. But the key thing is the Mediclaim would have covered for her hospitalization, but now she's out of the hospital. After maybe 2-3 weeks, she was out of the hospital, and that's when the Mediclaim really stops, even if she had it. So now that she's actually paralyzed and can't really even have sensation in hand and feet, there's no way she can actually work. So it really impacts her working life, which can be her whole career. Her whole earning capability is actually stopped. So the disability part is something which can happen to anybody, and we should get covered for that, because that's actually something which Mediclaim won't cover for the rest of your life when you are at home disabled. So that's where the personal accident insurance covers what you call permanent total disability and permanent partial disability. There is some specific things which qualify as total disability and specific as partial disability. In her case, it would have qualified as total disability, and she would have got the full 5 lakh cover if she had got 5 lakh by just paying a premium of 500 rupees. So you can just imagine paying a 500 rupees today to get a 5 lakh cover, which doesn't increase by age. It's offered till age 70. So unfortunately, it's not there for lifetime, but till age 70 is not bad. Now, if there's a partial disability, it's like you have one finger broken or one finger or one hand incapable of use, then that's like partial. So they already defined what is partial and what is temporary, what is total and what is partial, sorry. And this is something which, again, covers both permanent total and permanent partial. Now, there are optional things which personal accident do cover, which I would recommend you to go for that also, optional things, which I'm going to talk in the next slide, which is called temporary total disability, where you may not be considered as permanent disabled, but you might be out of work for, say, few months because of the injury. And that even few months could be a lot of financial strain for the family. So if you had an insurance of 5 lakhs by paying just 500 rupees and you actually qualify as temporary disability, they would pay you 1% of the sum insured, which is 5,000 rupees in this case per week. So 5,000 rupees per week for 100 weeks, which is 5 lakh rupees. So for 2 years actually you get covered if you buy this particular option with the personal accident insurance. Another option which is good is medical expenses benefit, which pays about 40% of the medical bills. Now, you may not be actually covered under Mediclaim if there is no hospitalization. So somebody has a fracture and is just in the hospital for a few hours and goes away. So Mediclaim can't really cover you for that. But if you have this particular option, and if there is a bill of say about 10,000 rupees for this fracture related expenses, 40%, about 4,000 rupees would be paid by the insurance company, which is still something you would get out of the policy which you already have. Hospital confinement, not as great, but still a good option. If there is a hospitalization, they'll pay you 1,000 rupees per day for 30 days, which is about 30,000 rupees. So if you have all these three options, your premium would go to about 1,800 rupees per year instead of 500 rupees. So about 4 times the jump. So you can roughly say about 2,000 rupees or so if you're willing to spend for personal accident insurance, you will be well covered for accidental death and accidental disability. So I forgot to mention about accidental death, because you might have a life insurance policy and which actually will cover you for accidental death, but if you have this accidental death covered with personal accident, which will also pay you along with your life insurance policy. So your life insurance policy of say 10 lakhs will pay you even for accidental death, and this accidental death cover of say by paying 500 rupees for 5 lakh rupees for a 5 lakh cover would actually pay you or your family for accidental death. So you would get from both life insurance 10 lakhs and 5 lakhs from the personal accident policy. So this policy actually works with Mediclaim and life insurance. So you don't have to worry that you won't not get paid. You will get paid even if you have Mediclaim and life insurance. Life insurance do offer these things, that is accidental death and accidental disability. It comes as a rider. So you have to buy the rider with your life insurance policy, whether it is a term life insurance or endowment or ULIP. Most of the policies offer this as riders where you pay extra money to get it. Unfortunately, it covers only permanent total and permanent partial disability. It doesn't cover those optional things which I was mentioning about. And that's where we feel that personal accident insurance is more comprehensive than taking life insurance riders. So you have more options of taking and more comprehensive cover. Also, what we found, one aspect was the premium in the life insurance rider in some of the policies actually increase with age, which it doesn't in personal accident policy. So you might want to just consider personal accident policy instead of the riders. Critical illness is another rider I have mentioned, which is not part of personal accident policy, but you can get it as a standalone cover from an insurance company, general insurance company, instead of buying as a rider. So that also is available, independent policy. So we come to life insurance, and as I mentioned, wanted to clarify that life insurance will pay even for accidental death, but having a rider of accidental death or personal accident will double the cover, or whatever is the amount which is covered. So how much cover you need? People ask. We say 10 times the annual salary is something which you really need. If insurance company is willing to underwrite for more, some insurance companies give up to 15 times or even 20 times. You can think of it. So even if somebody is earning 5 lakh rupees per year, 50 lakhs is minimum they should have. If they can get up to 1 crore, nothing like it. I think some companies are offering it for even 20 times. If you have liabilities, actually then it should be additional, because you have home loan of say 20 lakhs, then you should probably the bank which would have given you home loan would have made you take the policy against that, so that they don't have to worry about what happens in case you die. So they would have made you take the policy. If not, then you should make sure you are covered. So your 5 times, 10 times your salary plus liabilities of any home loan or anything, minus any assets, that is any savings you have. So if you have good amount of savings, then actually your life insurance requirement does go down. How long? Retirement or age 75. What I want to very much clear is life insurance is actually for covering your part where you have dependents, say spouse, children, parents, and they are depending on your salary. So you are earning salary, which is great, good salary, but it's not enough for your family to depend on if something happens to you. So that's where it covers during your working period. Usually can go up to age 75, but your savings, that is your retirement planning, should happen parallelly. So you can't say that you will just have life insurance policy and it will pay you anytime you die. I mean, it will pay you anytime you die when the policy is active, but the term life insurance they won't give you after age 75, because it's expected this person can die after age 75 anytime based on the longevity. So you have to plan for your retirement savings and your growth of your savings, so that by the time you retire, you have enough funds for your family to depend on, so that even if the policy is not there, life insurance policy is not there, your dependents have money which they can get from your savings. That is your retirement, pension planning or savings, fixed deposits, mutual funds have grown enough so that the whole family can depend on it. So your insurance needs, life insurance needs should actually be coming down to zero by the time you retire. If not, then you're not actually planning it properly. That is your corpus generation for retirement. Insurance, people ask us between online and offline plans what to buy, because it's like the premium difference is quite drastic. I mean, you have one place where online term plans are offered for say someone aged 27, 28 for a 50 lakh cover for only like 5,000 rupees. And you have offline plans which can cost up to 15,000 rupees. So why is it so? And most of the time the insurance company will say that, well, there is no agent involved and that's why the savings is, but that's not the actual reason, because the agent not there can save you a little bit of money, but not 3 times the savings. So in a way, if LIC is offering for 15,000, why is online term plan for 5,000? And we covered it in the cover story, where one of the big assumptions they are making is the customer profile. They are looking at few cities. So some of the online plans are offered only for few cities, and they're saying if you are within this city address, then we will cover you. If you are in a rural area, some village will not cover you. And that's because they are assuming that a person in a proper city with a proper tech savvy enough to buy online policies, probably financially well off or having a good access to healthcare. So they would be having good hospitals close by to where they live, and that they actually won't die. That is their assumption, insurance company, that you might actually be unhealthy, but you will prolong for a long time enough for the insurance policy, life insurance policy to get over, and then the insurance policy doesn't have to worry if you die after the insurance policy gets over, because they already got the premiums. So that is the main assumption they are making. Mortality rate is something what is called as we feel is calculating the covering you the risk by charging you some money. So whatever money, like the online term plan, they're charging you 5,000 rupees for 50 lakh cover. That is actually the mortality charge. And you can say, is it artificially low compared to LIC, which is offering 15,000 for the same policy? Yes, it is little bit low, on the very lower side, because LIC over the years they have come up with a mortality table which is the industry standard, and the online term plans are actually not used it and they have reduced the premium drastically. That doesn't mean LIC mortality rate is perfect, because they are not really updated over a period, and probably based on the longevity and other factors, it could get changed. And LIC also is planning to come up with a new term plan this year, and I think it's going to be online. So we are all waiting to see what kind of rates they would be offering, whether it is close to what other online players are offering, or somewhere a little higher. Maybe it might be a little higher, but it will still be a game changer, we feel. Will you really get the quotes? That is online term plans. They are saying, yeah, 5,000 rupees, just fill up the form and you will get the policy. Just make an online payment and it's done deal. We have not seen that. We have seen that most of the online term plans, they will make you do a medical test. Even if you are young age of 27, if you are wanting to buy 50 lakh cover, they will make you do a medical test. And based on the medical test, they might say that, well, some little bit problem is there. Even if it is a marginal number here and there, they will say, well, based on our medical reports, you are going to pay 7,500 instead of 5,000. So either you accept our offer of 7,500, or you pay the medical, will deduct the medical test cost and will refund you. So either way, it's a little bit of debate in your mind whether you should go with 7,500 or lose that money for medical test and get the refund. Which is your choice, and we would say you would be fair to assume 20-25% increase in the quoted rate. So if they're saying 5,000, you might end up paying 7,000 in reality when you actually get the policy certified by them. So then the difference between 7,000 and 50,000 looks a little lower, maybe half instead of 3 times. Okay, wealth management. That's where the insurance company is actually interested in. The term plan is actually not one of their main products. They are not really too much keen in that. Their whole purpose is the wealth management. They want insurance cum savings products to be sold. And the whole philosophy with it, which many people have, and this ULIP endowment of money back, is something called disciplined long-term savings. That is, somebody in a way is forced to every year give a certain amount of premium. So you're forced to save, and the discipline is because if you want to surrender the policy, you are going to get a very low amount back. So you are then forced that you will save every year whatever you committed, and you will give it to the insurance company. Some part of that will be used for your risk cover, that is insurance cover, and the other part will be invested. So it's a combo product of insurance cum investment. What you need to be aware of it is that the charges and mortality rates, both charges in a way, there is something called premium allocation charge, policy administration charge, fund management charge, which will be charged to you, which is quite hefty. Fund management charge, okay, it's a little lower than mutual fund, but the premium allocation charge and policy admin charge is quite hefty. They have come down post September 2010, but it's still on the higher side. So you are paying good amount of charges. For the traditional plan, that is endowment and money back, you don't actually see the charges because it's a very opaque product. They don't even tell you how much is invested or how much is insurance cover. You know insurance cover, but how much money is going towards paying for the insurance cover, that they don't tell. So charges are hidden, but just knowing that the first year commission the agent gets for selling you a traditional policy is about 35-40% will tell you that if the insurance company is paying such a high commission to the agent, it means that what they are actually getting in the first year is quite low, maybe 50-60% of your first year premium. So their investment portion is not going to grow as much as it would be in some other financial products, and you need to be aware of that. The only thing with traditional products is that you don't have to worry about you will be given a certain sum assured plus some bonus, which actually can differ. Some bonus might be good, but you can't really rely on how much it will be when your policy gets matured, because we have seen the returns calculation for LIC, and we have seen that if you go for a longer term, 16 years or above, the endowment policy of LIC has given 7.5%, which is not bad. But if you go only for 10 years policy, it will give you only 5%. So you need to be aware that you want to go really for a long term if you want good returns, and that too they're not assured, because the calculation of 7.5% on a 20-year LIC endowment policy is historical calculation. What goes in next 20 years, no one can really predict based on the interest rates in the market. And the final addition bonus, actually the agent might say, well, LIC has never reduced the final addition bonus. That's not true. They have reduced it. It has come down over the period. So if your policy is getting over in a year when they reduce the final addition bonus, which means that you end up getting lower money on hand when the policy matures. Mortality rates, again, it's transparent in ULIP, but it's not easy to calculate. For a layman, you have some factors and you need to multiply and then find out how much charges are going towards mortality. And if you actually do the calculation, the charges is in line with LIC table. In some cases, it is much higher than LIC table. So you have to be really careful. If you want to buy ULIP, you might not really know how much the company is charging for insurance component unless you actually work down what is the mortality factors they are using and what is the actual mortality charge they are calculating based on the table they are using. Every insurance company is doing their own way. Returns again can differ. I mean, some endowment might give even just 2-3%. We have seen where we had a cover story where we are saying some policies are quite toxic, and you might see the name endowment and think, well, this is same as other endowment, and no, unless you know what is the history of bonus and other things, you might not get the right thing. Tax savings, it used to be that to get tax savings, you need to have insurance cover of 5 times the premium. Now it is increased to 10 times the premium, which means that the regulator wants it to be sold as insurance products and not as investment products. And that's good because it's supposed to be insurance product. The only thing is with 10 times, those who are looking for investment, they're going to be at a little bit of a disadvantage because more portion of the money will go for mortality rates because of the high insurance, high risk, high life insurance cover. Liquidity, you can get loan on traditional plans, 90% of the surrender value. Again, it's going to be very low because surrender value itself is low today. So you won't get any surrender value unless you pay 3 premiums. And even after paying 3 premiums, it's only about like 30% of whatever premium you paid minus first year premium. It's quite low. You don't want to surrender it unless there is a very good reason. So we have a cover story which we are saying that doesn't really make sense to surrender it unless you really, if you already made a mistake of buying a traditional, you may as well continue or turn up into a paid up where after paying those minimum period of 3 years, you just don't pay, but don't take out the money because at least you will get something back after the end of the policy term. So this is how I'm trying to compare the online term plan premium with, we have another online ULIP from the same company, Egan Religare, and actually the ULIP factors which they are used is actually lower than what LIC table is. So, but if you just see, you're paying only 5,350 same number every year for an online term plan till your policy matures for 50 lakh cover. And here the mortality charges are actually growing so high that you actually don't know that you're paying such a high number for your risk cover, which is not really worth, because why would you want to pay 23,000 when you can cover at only 5,350. So you need to be really aware of the mortality factors, what they are using, and this is actually lower than LIC. So you can imagine how much traditional plans and ULIP are actually taking out for your risk cover. So the less charges you pay, less charges, better returns you can get. So you can have more money invested in some other financial instruments. It can be bonds, it can be fixed deposit, mutual funds. You have more money saved for that instead of, by paying something which you don't know of, how much you're paying for charges and mortality rates. So we say that life insurance is not an investment, it is a money for contingencies. Just keep it separate from investment. And if you buy a term plan and your term plan gets over at the age of retirement or at the age of 75, don't think it is a vestige of premium. It's not. It has covered you during your working time, that if something had happened to you during your working time, your family gets the benefit. But if nothing happens, it's great, you're alive, so which means that your premium is actually not vested, but that's good news that you are alive. Annuity, we had a question, somebody has just asked about annuity, where they want to invest in annuity, and they want to invest for 10 to 15 years. There's no period of annuity investment. Actually, it is for lifelong. So what annuity means is that you get a regular stream of income throughout the life of the policy holder. So if you are at age 40, LIC, I think annuity rate at age 40 is 7%. So if you give a lump sum of 1 lakh rupees to LIC today, they will give you 7% guaranteed for the rest of your life. Even if you live for next 60 years, that is, even if you reach up to age 100, they will give you the 7% guarantee. That is 7,000 rupees for that 1 lakh of investment you will get every year for the rest of your life. And when you die, your nominees will get the 1 lakh rupees of principal. There are options where if you want more than 7%, you can tell LIC that I don't want my nominee to have anything. I just want it during my lifetime. Some people don't have dependents, and they say that I don't want to give money to anybody. So you will get maybe 8, 9%, 10%. But the risk here is that if you die a few years after buying the LIC policy, that 1 lakh is gone to LIC. If you live longer, then LIC is, taking the risk of your longevity. So what LIC or any insurance company because annuity is now offered by many insurance companies. It used to be LIC, which is more prevalent. 95% of annuity business is LIC, but regulator wants all the insurance companies to have annuity products, and we've seen good competitive products come out which is competing with LIC rates. So you may want to shop around. The main thing is it's going to lock in your money, so that 1 lakh rupees you give, LIC is not going to give you back during your lifetime. That you have to be prepared for. That you are going to get 7,000 rupees rate of return, that is 7% rate of return every year guaranteed for your life. But if you ask them to give you 1 lakh rupees back, they may not, unless there is some terminal illness and you show very compelling reason, they might consider. But the other reason why they will give you back other way is that if the fixed deposits today are say 10 years from now, if they are giving only 4-5% interest, then LIC is giving 7%. So the LIC, if you go and ask for that 1 lakh, they will give you back, because instead of you are actually a loser if you are going to ask them, because your fixed deposits is going to give only 5% and LIC is going to give 7%. So you shouldn't ask to get it back. But if you really need that 1 lakh, at that time they will give you. But if the interest rates are 12% for fixed deposit, they will never give you, because they are paying you happily only 7% and they are investing in fixed deposit at 12%. So they will never give you in that particular case. Pension product is actually deferred annuity, wherein instead of giving a lump sum and getting immediate annuity, what you are doing is you are giving periodic money to the insurance company during the accumulation phase, because you may not have a lump sum money. I mean, lump sum money usually at retirement you might have, and there you can buy immediate annuity. During your working time, you might say, okay, I'll pay 5,000, 10,000 rupees in the pension product, and it will accumulate for 20 years and give some rate of return in the 10, 15, 20 years. And after that, you can use that lump sum to buy annuity product. Unfortunately, the pension products today are not great. Actually, there's none in the market, because regulator has just changed the structure and they want something called non-zero return. That is, whatever you pay over the 10, 15, 20 years of accumulation, that the insurance company has to give you something back. They can't reduce your money because it's supposed to be for retirement. So they want to make sure you don't end up losing money. But on the flip side, what's going to happen is they're going to invest more in the debt market, which will limit your returns. So you might get your money back, but it may not be a good return. So you might just get something back with few percent return, which may not be great. So you might have other options for retirement, where you have already PPF, you have employee provident fund where 12% is deducted, employer puts in another 12%. You have variable provident fund where 100% of your basic can go towards the provident fund. The employer will not match anything, but your 100% of basic can be put along with your EPF, and you'll get 8.5% return today, which can change every year, but still decent amount. Just like PPF, it can grow for your retirement. And new NPS is another product, new pension scheme which has come out, which is, I would say, still much better than the pension products which guidelines which the IRD has come out with. So NPS is another option. Any questions, I hope there is clarity.
Can you just explain the variable provident fund as in how it is different from
Yeah, EPF, PPF is something which you do it from, up to 1 lakh you can put now, and that's under ATC tax deduction. PPF, EPF is something as an employee, 12% is deducted, and employer matches 12%, and it goes. VPF is variable provident fund, which is 100% of your basic can be put into the same account, but you can talk with your employer, and 100% of your basic can be put in, and that becomes tax free also at the time of maturity for sure. And it can come under the ATC also, 1 lakh limit. So yes, it will come under both ATC 1 lakh limit and tax free at the time of maturity, both, just like a PPF, EPF. Whole life policy, yes. Whole life policy is wherein there is an accumulation period, just like a pension policy. So you have first accumulation phase similar to the pension policy, and after the end of the accumulation phase in a pension product, you have to buy an annuity. 1/3 you can take out tax free, and 2/3 has to go to annuity, and that's a pension product. In whole life policy, on that accumulated fund, the insurance company actually tells you how much return they will give. They might say we will give you every 3 years, every 5 years you will get a certain amount of money till you die. But again, it is coming out of the money which you have accumulated over the period. So it's not something which they are doing something great risky job for themselves, because you have accumulated. They might say, okay, 5% rate of return or 4% they will guarantee or something, and they will give you every 5 years. They won't give you every year, I think. They will give you every periodically. So you get some money coming in for the rest of your life. And it is tax free. That is the only thing. Annuity is taxable in India. That is another point I forgot to mention. Annuity, unfortunately, is taxable. So 7% LIC what they're giving is taxable if you're falling in the tax bracket. But in the whole life policy, whatever they give, it's not called as annuity. It is just a return they give periodically after the accumulation phase, which is tax free.
As well, I can keep for 10 years in any bank and I will get 8 or 9%.
Yeah, but the bank is giving you only for 10 years, right? No bank is giving you more than for 10 years.
Because I should get equated monthly installments, like capital plus interest. Whole annuity should exhaust at the end of 10 years.
It doesn't exhaust at the end of 10 years. You can say that you don't want to give it to the dependents. You have 3-4 options, I think. One of the options is you want to give to dependents. One of the options is you don't want to give to the dependents. So it will give you not just for 10 years, it will give you for the rest of your life, maybe 8, 9, 10%, because they are taking the risk that if you die early, they get the whole lump sum from you. The return of principal will give you a higher rate of return because some part from the principal is given back to you. But if you live for 60 years, actually insurance company may be at loss because the principal might be eaten through and you are living longer. But that's their risk they are taking. They are taking the risk of interest rates and longevity. So if you live shorter, if you buy today and unfortunately after 2 years that person is not there, then the whole principal is got by the insurance company. That's a trade-off where you want to have that option of nominee getting the principal back or not getting the principal back. And there are 2-3 more options. Maybe there is an option for fixed period also. One more point is annuity. Most of the products are offering from age 40. So people who are less than age 40 here might think that there is no option, but there is one option we have found. There is Tata AIG policy which is offering from age 21 annuity. So actually if somebody wants to lock in at a young age, for next 50, 55, 60 years, 70 years, till that person dies, Tata AIG will give you whatever 7% or whatever rate of return, which is locked in, which is a high risk they are taking because the interest rates can change drastically. In US, it used to be like 2006, 6% fixed deposit. Now it is like less than 0.5% or even 0.25%. But the Tata AIG, again, I don't think the product is marketed much because the company is not really interested in selling that product. From what I hear, I mean, they actually want to revoke the product, but the regulator is not really allowing them to take out the product from the market. So it's still available. If somebody younger than age 40 wants to consider annuity, that product is there. But you need to compare the rates because we just read LIC is offering 1% higher rate for online purchase of annuity. So instead of 7%, they're going to give you 8% at age 50. age 50 it was 7%. So if you buy online, you might get 8% that annuity, and that's something which just came out last month. So if you want to shop for annuity, you need to compare the rates because it varies. We saw Max New York Life offering 3.5% for the same age 50 instead of 7% of LIC. So it's going to be so much different that you don't want to just close in on one option without really comparing, other insurance company products before buying, because you might end up locking in that money at a much lower rate than what the competitors are offering. Child plans, traditional. It's actually a traditional or a ULIP with a waiver of premium. It's a feature. The catch here is that the parents feel that if you buy a policy for the child, then if something happens to the parent, then working parent, then the child will get the money at the time of going to education. So the money is actually not given. Some policies will give you some sum assured at time of death, but the fund value or whatever will be kept till the child reaches age 17 or 18, and you can decide that, and that's where the money is given for education needs. So there is little bit of emotional connect where they want to make sure that the child is secured for getting the money, and the money doesn't get misused by somebody else, when they get it lump sum. So that's the trade-off, whether you want to go for a term plan and fund it, or you want to go for a child plan and get it in a more structured manner. The only thing which you need to be aware of is that whatever extra risk the insurance company is taking, that is what you call waiver of premium. That is, all your future premiums are waived after the death of the earning family member. The waiver of premium comes at a price, because the insurance company is always trying to figure out how much is their sum at risk. So that sum at risk actually is much higher at the start of the policy, and as it comes to the end of the policy, their sum at risk is lower, because then the premiums are paid for 10, 15, 20 years, and if somebody dies immediately after buying the policy, 10, 15, 20 years of premium will have to be paid by the insurance company. So based on that sum at risk, they are going to charge you higher money. So you might think that you are generating good corpus for your children, but you need to worry about how much are the charges and the mortality rates, because from your 100 rupees of money premium given to insurance company, maybe 20 rupees is taken for the insurance cover and only 70 rupees is invested. So you might think you're generating a great corpus for your child after 15, 20 years, but it might be much lower than what you anticipated based on the charges which are eaten, the mortality rates which could vary between insurance companies. Like I said, it could be much higher than LIC mortality rate, and you might end up paying more than what you actually supposed to buy. You can do the similar thing by term plan with mutual funds or something else. It's up to you how you want to play around, but that's what is there in the market today. Buyers need to be beware, because there's a lot of mis-selling which has happened in the past. Even today, we get calls, people saying that people call them saying that we're calling from the regulator, or it's not. No, regulator doesn't call like that or tell you. Then they say somebody calls from the insurance company, says that this policy is going to get discontinued. You better close the policy and move to another policy. The reason they are trying to do is that they want to make sure they get the commission for a new policy. They want you to surrender the old policy, make a loss for the policy holder. It doesn't matter. For the company, it is like good if they have to pay less, and the whole money is shifted to another new policy, and then they get the charges. First year charges are more. So the whole trick is that the policies will get over, or IRDA is going to remove that product. It's not. If IRDA has a product, it will never get removed. For you at least, if you bought the policy which is going to be there for next 15, 20 years, rest assured you don't worry about, even if that product gets discontinued, you have purchased it, it will continue. And in no way you should surrender it and move to some another product from the same insurance company, because that's the trick they want you to do. They want you to do exactly what they want, to get higher charges from you. So you have to really be aware of what is happening. Health insurance, let's work on that, because that's the next important part. I hope we are good on time. Health insurance, Mediclaim, what options you have? You have individual policy and you have floater policy. Floater is wherein you have a family, spouse, children. So you say you buy 5 lakh of health insurance, and that 5 lakh will be distributed among your family. So it's not for one individual. So one individual use 2 lakhs, remaining 3 lakhs are still there for the rest of the family to use in that particular year, and after 1 year completes, the whole 5 lakhs comes back. Senior citizen Mediclaim is a product which is specifically for senior citizens, because if you have not bought it during your young age, if you had somebody met me age 65, they want to buy a Mediclaim, the options are very limited. You have to end up paying little bit higher premium and little bit more restrictions in terms of what you call co-pays. That is something from your pocket. That is, if there is a hospital bill of 1 lakh, then maybe 30,000 you have to pay from your pocket, and the 70,000 the insurance company will pay. That's a co-pay, because that's the restriction they are putting on your policy at the beginning, saying that this policy comes with a 30% co-pay. It's a senior citizen product. You didn't buy it regular product during your young age, so now when you want to buy it, some restrictions will come. Critical illness will pay a fixed amount. If there is a specific critical illness, stroke, cancer, renal failure, you will get a fixed amount as long as you survive for 30 days or so. That's the condition. Top up, super top up. Super top up is a better concept where it's a deductible. The first part of the amount you are paying either from your pocket or from some other insurance company, and the insurance company will pay the remaining part. That is, you take a policy of 5 lakh and say that you are okay about them only covering after the first 2 lakhs. That is, first 2 lakhs either you will pay from your pocket or some other policy will cover, and they will cover the next 3 lakhs. So the premium is low. So if you already have a policy of 2 lakhs, then instead of buying a new policy of 3 lakhs, you take a super top up of 3 lakhs, because then your premium is little lower, and you are covered by the first policy for 2 lakhs, and the second policy will cover you for 3 lakhs. Top up, option is there by multiple insurers, but I don't recommend top up, because top up is per treatment or per hospitalization instead of across over the year. So super top up will add all the expenses throughout the year, and once it reaches a fixed amount of say 2 lakhs, it will start covering. But top up will cover only for particular hospitalization. So if you have multiple hospitalization, they will say you have to cross 2 lakhs for each hospitalization, then only they will start. Every insurance company has their specific underwriting policy. Some are little strict, some are little. Portability is come, and you can apply to the new insurance company. Portability doesn't guarantee you the premium. So what it guarantees you is the waiving of waiting period of pre-existing diseases. Premium can be whatever the new insurance company decides. So you might be paying 5,000 today. If you try to port to some other company, they might charge you 8,000. So either you accept that 8,000 or you stick to your 5,000 with your existing company. So the premium, whatever they want to set, is still given to them. That is, they have a right to set whatever premium. So they might charge you premium which might be unaffordable, and you might not want to shift. IRDA is making it a little strict. They are saying that for portability, if somebody wants to deny insurance company, they have to give some specific reason and file some details with IRDA why they are denying this particular person. So it's not, they are not saying you can't deny, you can still deny insurance company, but they're making it little bit stricter for the insurance company to deny. So they have to give some reasoning, proper reasoning to even regulator why they are rejecting a particular case. But again, it's not like they can't deny. I mean, it's their right to underwrite. Once they have taken you, then they will offer you the same sum insured. If the policy says lifelong renewal, they will offer you the same sum insured for the rest of your life, unless there was some fraud or anything. So once you get in, then you don't have to worry about not having the renewal. I mean, they will be forced to do the renewal till the policy ends, which now the trend is lifelong. So some policies today are only offering till 70, 75, 80. But the way forward is the draft regulation wants it lifelong. So that's a good thing once it comes through. And many products have come with lifelong renewal. So you might want to consider only a product which is a lifelong renewal. The only thing is the sum insured is another part where I'm going to talk about, where if you have say 1 lakh, many senior citizens I meet, they have only 1 lakh, and the insurance company is not willing to give you another policy or increase your sum insured. They are saying that, why don't you make it 2 lakhs, 3 lakhs? Insurance company is not. And that's where again the right to underwrite. They are going to continue with whatever insurance you took. They're forced to do that, but then to increase the sum insured, they may not. Especially if there is a illness, if somebody we know somebody had a cancer and she's now cancer free, but ICICI Lombard wouldn't increase the sum insured, and no questions asked. You will only get the same sum insured, but they won't raise the sum insured. So you might want to consider a bigger sum insured to begin with. I mean, going for 1 lakh, 2 lakh today is quite low. So 5 lakh, 10 lakh is a good option. I would say still 5 lakhs you should have, because medical inflation, somebody has a heart attack, 3 to 5 lakhs is the expense. So 5 lakh you would want to have, because 10 years from now that 5 lakh will also look less, and you may not even be able to get 5 lakhs, because the insurance company will say you stick with whatever you have, we are not going to underwrite you more for that. So let's just go a little fast. Fine prints, that's where I'm just talking about. The 5 lakhs to 15 lakhs is a good cover, and lifelong renewal is a good option, but you need to get the policy. They may not increase the sum insured at a later age for senior citizens, and if you have some illness. Copay we talked about. Room rent limit, where you might say 1% of your sum insured. So if your sum insured is 3 lakhs, the room shouldn't be costing more than 3,000 rupees per day of stay in hospital. So if the room is costing you 5,000, you might think you will just pay for the extra room rent. That doesn't happen. Many times the whole bill will get prorated, because say you are eligible only for a room of 3,000 and you stay in a room of 6,000, you might have to pay 50% of the bill. Because what happens in India is, it's not just the room rent, the whole expenses of hospital changes. The doctor who comes to visit you, he will suddenly have a different rate if he is visiting a general ward patient compared to a single room patient. The whole operation theatre procedure cost can double very quickly if there is a room change. So insurance company fairly enough doesn't want to pay from their pocket if you are going to a bigger room and spending a lot of money. Fine prints, limits for surgery, senior citizen mediclaim, you would have some limit wherein you might buy a policy of 5 lakhs and your surgery cost maybe only 1.5 lakhs covered. So you might be paying a premium of 5 lakhs, but your surgery, heart surgery or whatever procedure cost, they'll cover you only for 1.5 lakhs. Pharma, you might have a limitation, like stent cost, maybe only 40% will be covered. So you have 1 lakh cover, you have 1 lakh bill for stent, only 40% will be covered. Pre-existing disease, again 4 years is a standard. Some might say 4 years of continuous coverage with no hospitalization, or 4 years of coverage with no hospitalization for that particular condition, then only will cover it. Little restrictive, so make sure it is very simple. After 4 years they should cover. If they cover it after 4 years, should be happy, because standard is 4 years. There are now new products which are offering less than 4 years also, but very rare. There is a 2-year waiting period for specific things, cataract, hernia and other things, 4-year waiting period. So you need to be aware that you can't just buy a policy and go for a cataract and expect to be paid. They won't, because they want to make sure you wait for a certain period, because the policy will get misused. Outpatient procedures, don't go by the count, because some of the count, like Apollo has 140 or more than that, but then it's like they have eye surgery, specific surgery, then only they will cover. But if it is a generic one, that is eye surgery, like I think Oriental has, it will cover for a generic anything related to eye. If it is very specifically worded, then only those specific things will be covered. So just go by the broad definition of, and you need outpatient procedures to be covered, because kidney stone removal is now outpatient and you don't want to be paying for that. So you want to make sure your policy covers as many outpatient procedures and broader definition. Timelines, be very clear that insurance companies are getting very strict, wherein some of the companies are saying you have to inform us within 24 hours of hospitalization, or some might say 48 hours of hospitalization. If you don't inform them, if you just file a claim after 7 days or 10 days, they will say you will not pay the claim, because you never told us you were in hospital. They want to do it because they want to say we might visit the hospital, see if you're really there, talk with the doctor and see if this patient is really not a fake patient, and to put a false claim. So they are doing it for their purpose, but you have to be aware of these timelines and do all the filings, that is intimate the TPA beforehand within the time limit. Renewal, just make sure what are the terms and conditions which are getting changed, and if you're not happy with the change condition, then you can use portability. Claims loading, you might see a hike in premium. Some companies are having 200% loading. So you have somebody had a heart surgery and their premium increased from 16,000 to 48,000. So 200. So in a way, policy which is having a claims loading which is very restrictive is bad. If it is claims loading which there's no claims loading, then that's good policy. Cashless is the best option for pre-planned procedure, because you can actually get approval from the TPA or the insurance company beforehand. In emergency, it can be a little difficult to locate a cashless network hospital, apply for it. Pre-planned surgery, after 10 days you want to do certain surgery, get it So, hospital has a TPA desk, file for it. Insurance, they will send it to the insurance company or TPA, get it approved. There might be some queries, so give couple of days. They might say, we'll approve it within 2 hours, 4 hours. Doesn't happen. You give 1-2 days for approval because hospital desk itself might not be open 24 hours. Cashless network again can be a changing target, so you might want to make sure your hospital close by is on the network. Reimbursement claim usually takes 30 days. Pre and post hospitalization will always be reimbursement, even for cashless hospitalization. So you might still have to file claim for any doctor consultation or diagnostic before the procedure is done, and any medicines after the procedure is done. Delays can happen. Companies can raise frivolous queries, and you just have to fight it out, because sometimes the more you fight, the insurance company will pay you. I mean, you have to be persistent about lodging a complaint. If they don't pay you, complain with the insurance company grievance cell or with the ombudsman. Car insurance, third party is the minimum you need to have. It's mandatory. It's under tariff. The rates are low, so there's no reason why you shouldn't have it, because it actually covers the third party liability. You hit somebody, somebody gets disabled or dies, they actually can get a big amount of compensation from the motor accident claims tribunal. Unlike railway accident, which can limit up to 2 lakhs, there is no limit. So in a way, if somebody gets disabled and they are able to prove that they had a good job and good career and they lost, that person from Ravan movie, she can, if she goes to the tribunal and shows that she had a good job and everything, she can actually get damages from the tribunal, which can take a couple of years, but that will be paid by the insurance company of the driver who was at fault. So if you are buying a car or a vehicle, any scooter also, you need to have that third party cover. Many scooters forget about renewing it after a few years, but it's a big risk you're taking if you don't have third party cover. Own damage covers your car, that is, you are at mistake, they will cover you, they will pay for your damage, or theft, the car is stolen, they will cover it. Again, that premium for the third party is fixed, so there is no shopping around. It's all same. The premium for own damage varies a lot. It varies drastically from insurance company, and you need to be really shopping around for that, because discounts are given to specific channel. Dealer might get a discount 1 year, they might offer you at 50% discount. Some other channel, we call the insurance company, their own insurance company agent wouldn't offer that much discount as the dealer was willing to offer. So you might want to shop around, because based on the statistics the insurance company has, they change the rates, premium rates very fast. I mean, unlike life and health, the premiums, life and health premium doesn't change that much, but car insurance premium can change daily based on their analysis, and they might just target this year, that if they feel that Honda Accord of this particular year model is having less accident, they will offer a lower premium, and you need to be shopping around before your renewal date. Car model can make a difference. Sumo, Qualis, IndyCar, they're supposed to be commercial vehicles. Even if you are saying you're using it for private, they will still charge you more premium, because they're not sure. You might be lying to them. So they will say you're having a Sumo or Qualis, pay more premium, even if you're saying you want for private use. Location, New Delhi related, NCR has high theft, so premium will be higher for own damage. Fuel option, again, diesel will have more premium to be paid, because diesel cars again are for more commercial purposes, so they are classified as rental cars. Security and safety equipment, if you have, then you can ask for lower premium. Rating a driver is just started. Actually, it's nothing scientific and nothing which actually can work in reality, because in India the car is insured. The person driving is, as long as he has a driver's license, is okay, anybody can drive. So as long as a car is driven, so you might say you are a doctor or a CA, and some insurance company, I think HDFC Ergo is giving some discount, 5% discount if you are a doctor or a CA, and you take the discount. But even if your driver is driving the car, they won't find it and they can't do anything. I mean, you will just get a discount, and that's good for you, because nothing stopping your driver from driving the car, and they will be covered even if there is accident, because the insurance is for a vehicle and not for a driver. Again, the marital status, credit history is something just starting, just like US they are trying to do. But credit history, I just spoke with somebody from the experience, and they said that for some insurance company are looking it not for premium decision, but for claims related. That is, if somebody has a good credit history, they might say that this person probably won't indulge in a fraud, so they might not, do that much investigation if there is a claim for a car. No claim bonus can be transferred from your old car to a new car if you buy a new car. Insurers have knock-to-knock agreement, which means that if somebody else is at fault, you still file a claim with your insurance company and get your car damage fixed. So in a way, it's convenient. You don't have to go to other insurance company, that is the party at fault insurance company. You just file with your own insurance company and get the claim paid. But your no claim bonus is gone. So that is the flip part. That's why I said beware, because once you file the claim, your no claim bonus, which could be quite substantial saving, is gone once you file a claim. Even if it is not your mistake in accident, because you filed a claim, it's gone. IDV, it's the insured declared value. If the car declared value, somebody might just tamper with your value and say they might reduce your value in the policy and offer you lower premium, but it means then your car worth is actually reduced on paper, which you shouldn't want to do, because if your car worth is 5 lakhs, then don't have a IDV of 3 lakhs to reduce premium, because if there is a damage, then they will only cover up to 3 lakhs, but you want to up to 5 lakhs if that's the actual value of the car. Overseas Mediclaim is very important, especially if you are traveling to US, Canada, even Europe, because the cost is very high over there, and for older age the premium is quite high. So if you're going to these countries, you need to be aware that the premium can be quite high. Other parts not that great. Loss of baggage, passport loss, it doesn't really make much of a difference. But the overseas Mediclaim is something really required for these countries, because it's a big amount of expense if there is a medical condition at overseas. Because your Indian policy, Mediclaim is only covered in India, Bhutan and Nepal maximum. Doesn't cover beyond these 3 countries, most of them. Go ahead, sir.
This overseas Mediclaim policy, does it cover pre-existing diseases if I go to some place?
Pre-existing is a very good question. We have it. Is it really covered? Most of the policies don't cover it. So they clearly say we will not cover it. And a few of them which say we will cover it, the wordings are such that they will cover it only to an extent of you making you stable. That is, if they feel that this person can travel back to India and do his heart surgery, they will say you better go back to India and do the heart surgery. We won't pay it in US unless there is a very emergency to make you stable condition, or if there is a real emergency, they will allow heart surgery. But if they can delay for a few days, they will make you change your plans and go back to India for covering this pre-existing conditions. And lack of medical tests is another botheration, because most of the policies don't do any medical test. It's like supposed to be bought quickly before somebody wants to go abroad. But having a medical test is a good thing, but since they're offering without medical test, the chances of them trying to justify that you had some condition which was already there, which got aggravated while you're abroad, is high. So they might actually try to tell you that we won't pay you the claim because you had some condition which you didn't declare and there was no medical test done, so you are actually at loss trying to prove that you didn't have any condition. So you need to be aware of that. Cashless network can also be a worry, because you might be at a place where that insurance company may not have a cashless network, and you might have to pay from your pocket, which can be a big amount for hospitalization, and they will reimburse you. But then again, that risk is there. If there is a 10-20 lakhs of hospitalization bill in US, then who will pay? I mean, you are not in a network hospital, so you might have to pay and then get it from the insurance company, which might be a fight if there is some discrepancy anywhere.
I got a problem.
Yes.
If I'm more than 75 years of age, I find difficulty in getting a medical insurance policy from Indian agents.
You're talking about Mediclaim overseas or Mediclaim in India?
No, Mediclaim overseas, because I had been recently twice abroad, and I had a lot of problems in getting Mediclaim policy in India. So I had to get policy from abroad.
Yeah, I mean...
so how this problem could be sorted out in India?
Some policies are offering for longer age than 75 also. You might want to look.
I'm 77 and I had a lot of problems. So I had to get policy either in Canada or USA through my children who are staying there.
But there also, yeah, if the Indian company is not willing to offer you, then it's definitely disadvantage. But even if you buy it over there, you need to be a little bit aware of it, because over there, if you're buying from a reputed company, you might be a little bit okay, say Kaiser or Blue Cross Blue Shield. But if we have seen some Indian operators also trying to sell some Mediclaim over there, and they might just take the premium, and you don't know who's actually underwriting it, and if there is a claim whether they'll pay or not. So either you're okay with buying from an Indian company before going, or a good US company or Canada company, and not some small time names which you actually don't know of. So, but you can shop around. I think some policies are offered for older age also, but the premium can be quite substantial. Domestic personal accident policy does work abroad, so you don't have to take another PA policy. It will work abroad. Home insurance covers either the structure or the contents or both. Structure, just need to be aware that if your home is worth 1 crore, doesn't mean that they will pay you 1 crore. So don't insure for 1 crore, because the policy is actually for reconstructing in the same shape whatever it was before. So it's just a cost of reconstruction of your home, and if it is not in the perfect condition, they will actually even, it might be only 10-20 lakhs of reconstruction to be done. So you might want to cover only that part and not the actual worth of the home. And that's just people are just starting to know about this particular policy, and it can cover the contents of your home also. Grievance redressal, we said insurance ombudsman is your best friend, because it might take 6 months to get an appointment, but if there is a grievance and if the insurance company grievance cell is not answering, you already proved that you filed with them, you can go with ombudsman filing, and it's there in Mumbai is there, I think. So you might have to come to Mumbai, because he's in Mumbai and Goa. But I think we are seeing good results from them. I mean, wherein if you have a proper case and you don't have to have a lawyer, you don't just go yourself and represent yourself. He will hear you and insurance company official and make a decision, and that is binding to the insurance company. They can't really take it to the next level for appeal. So anything 20 lakhs and below personal claim, they will handle it, and it's a good option. Consumer court, you can't have both the places. You can have either an ombudsman or consumer court at one time. And consumer court also, we have seen in newspapers, you might have kept on reading, where a lot of decisions are in favor of the insured, that is the policy holder, and that's a good option. But consumer court might take a little bit more time and might involve some cost if you want to go with some lawyer or something. So insurance ombudsman should be your first bet. Civil court, that's the last step if you really want to pursue it to high court or whatever. Lack of will, people give up. Senior citizens, very difficult to keep on fighting. But I think the insurance regulator also might not look at individual case. You might send a complaint to them also. They have a helpline, and good to have IRDA also get an official complaint for you and get a complaint number from IRDA. But I don't think you will get a proper, I mean, they may not look at individual cases all the time. So ombudsman may be a better option for you, but it's good to have IRDA also aware of it. So litigation cost, only if there is a consumer court or civil court, and time, it might take some time, 6 months to get appointment for insurance ombudsman.